and welcome. You have tuned into Buy Now, Sell Now on ET Now. I'm Srishti Sharma and with me is Ankita Saxena. And viewers, this is the show where you get answers for all your stock-related queries. And I'm sure that, yes, of course, with respect to the action in the market, you must be worried about all your stock investments. And we are here to guide you with our whole host of experts that will be joining in a while. But before that, let's have a quick look what the markets are up to. So the gain continues. For the first time ever, we have seen a 4-digit gain coming in on the Nifty 50, but now sub that mark. It's a 700 points of gain that Nifty 50 is still holding on to. Nifty Bank, more than 1,500 points of gain as we speak right now, and all across the board, the sectoral performance is something that you see it, and it's definitely green all across. But the biggest of all, the biggest gain with respect to the sectoral performance is actually in the Nifty Realty, given the fact that this was one of those beaten down sectors, and with this sort of a positive news flow coming in, even Realty Pack is definitely participating well into this. The auto ancillary counters, be it the other gems and jewelry stocks, the textile related counters, all these counters are buzzing, and seems like that the most of the gains are something that these stocks will be holding on to. But along with that, what's interesting to see is that some of these chemical related counters are also doing very well in trade, be it Garvare, be it Aarti Industries. The kind of optimism around that now that the US markets will be open for all these companies are definitely impacting the stock prices, impacting with a big move rather, because Garvare is up more than 17%. Aarti Industries almost 12% of gain is what we are getting to see. All these gems and jewelry related counters, be it Web of Global, more than 11% gain is what we are getting to see. Adani stocks are on fire as well. And add to that is some of these beaten down names, be it CDSL, NSDL, these counters are definitely having a great run. But yes, Ankita, great moves on the markets indeed.
Absolutely, Srishti. It is a great day coming in. It's a historic deal that's come through that we have been waiting for. But let's take stock of how it is impacting the companies. And for that, we are joined by Naresh Jalan, who's the MD of Ramakrishna Forgings. Hello, Mr. Jalan. Thank you so much for joining us. Now, remember, as far as the impact and size is concerned, India accounts for just 3% of the $97 billion worth of auto component imports by the US. But the US accounts for 27% of the auto components exports made from India. Let's find out how is this likely to impact the auto and companies. And Mr. Jalan, first up, my question is that, earlier you had guided that there will be no impact of the additional 25% punitive tariffs because it falls under the standard global tariffs and no auto, as far as, it only applies to the non-auto forging. So how much of a tariff impact are you likely to see for the auto component exports and the non-auto forgings?
So non-auto forgings will come back to 18% for oil and gas and industrial equipments. But auto tariffs, which fall under chapters 232, I think whatever we have heard post this deal announcement from our customers till today morning is that India has been given or is supposed to get an exemption from chapter section 232 in terms of auto components, and that will also be coming under 18%. So we will need to wait for the fine prints to emerge in a couple of days. But I think probably as Japan and Korea have got that, India is also supposed to get that. And if that happens, from 25%, auto component is going to move to 18%. Industrials and oil and gas sectors have already moved from 50% to 18%.
All right, that's indeed a good number to start with. Mr. Jalan, morning. This is Srishti also joining in. Thank you so much for that clarification. But why don't you also tell us that how this bifurcation and the new rates are going to impact you and the business?
Good morning, Srishti. I think overall, we had seen a lot of downtick in demand in the previous year. And I think probably from this quarter onwards, we are seeing an uptick in demand in the US market. Because of the subdued demand, our exports to North America had considerably fallen down in last 9 months. But probably we will see this quarter onwards, North America exports to pick up. And I think this icing on the cake is going to be this duty reduction, if at all it happens. Overall, in terms of RKFL's performance, I think we are going to grow double digit in terms of exports in financial year FY27 in terms of North America with the addition of new customers, which we have already had. But probably, I think with this happening, we are expecting further up boost in terms of overall prospects of RKFL doing better in North America going forward.
Mr. Jalan, like you mentioned, like in the last few quarters, the demand has been rather subdued and muted. What could be perhaps the demand projections for the next few quarters, given that now we have a relief coming in as far as tariffs are concerned?
No, I don't think it is anything to be done with the tariff. I think overall in North America, if you see the build rates of the OEMs were pretty down in last 9 months. Probably the entire year, calendar year of 25 has gone with a lower build rate in the heavy duty trucks and the medium duty trucks. Probably from this quarter onwards, we are already seeing there is an uptake in terms of the warehouse pickups from the OEMs over there. And probably this is going to continue, and the momentum, the way it is building up right now, we probably see that the calendar year 24 demand is going to be back by June quarter onwards for us as well as the North America market.
All right, that's good to know. But along with that, Mr. Jalan, one of the other recent FTAs that has been signed was with respect to the European markets. If you can just give us some sense that how do you see this whole trade deal? I know that you don't have a significant exposure in this market, but from an industry standpoint of view, how do you see this particular deal opening up the doors for the ancillary players like you?
No, Ashishti, I think probably we are doing extremely well in Europe, and this FTA with Europe is going to give a significant boost to the overall cost competitiveness of industries from India in the European OEMs. We were paying right now in built-up cost of close to around 5.5% duty, which I think going forward post this implementation of FTA, that duty is going to get offset, and probably we are going to become more competitive vis-a-vis our competitors in the European OEMs, which will attract more businesses going forward. The RFQ flows and other things being consistent, we were still uncompetitive compared to other geographies. But I think with this duty reduction, which is going to happen in the auto component sector, the domestic industry from India is going to gain immensely in the European market.
All right, Mr. Jalan, on that note, thank you so much for joining us and answering all the questions on the trade deal that's gone through. Ramakrishna Forgings, as of now, trading with gains of upwards of 10%. And that's how the mood of the market is right now, cheering the deal that's come through. But with that, it's time for us to slip in a short break. Don't go anywhere. Post the break, we're getting more managements and see the impact of this trade deal. Let's take a break first.
Welcome back, and now let's get in conversation with the management of Transrail Lighting. And for that, we are being joined by Mr. Randeep Narang, who is the MD and CEO of Transrail Lighting, joining us on the show. So first up, let's talk about your earnings then, because given the significant surge in the Q3 EBITDA as well as your revenue, how sustainable is the high rate of growth in the immediate term is likely to be there, and what specific drivers will ensure this trajectory continues in FY27 as well?
Principally, if you see, we have been giving the guidance of 11.5 to 12% since our IPO in December last year. So principally, we believe that we have a strong order book, a good margin profile in these orders, and we will maintain the same profile going forward in the coming few quarters of 11.5 to 12%. And this is sustainable. It is also based on the quality of the order intake and a risk matrix where we pick and choose the orders, and therefore we believe that that's very important in our growth journey.
Mr. Narang, what would be the revenue guidance for Q4 and also FY27 going ahead?
We had, in fact, in the last call, I had mentioned that we would be from a 24-25% growth over last year, we would be in the range of 26-27% post monsoons, and that is what has exactly happened. We picked up our execution process, domestic and international, post July August. So we believe that this is what we will do. 26-27% is one of the best in the industry, and we believe that this is where we want to be. And if we can do more, definitely the teams are stretching to beat this also.
All right, but along with that, Mr. Narang, your order book guidance was at 9,000 to 10,000 crore for FY26. You have already received orders worth more than actually 500 crores in the 9 months of this year. Are we on track here to reach the guidance given earlier? Because you might have to catch up a lot for the fourth quarter. What's the visibility?
Principally, we have crossed 5,000 crores of order intake already. 3,400 plus crores is our L1, which we hope to fructify in the next 30 days. And we also have a bidding pipeline of another 15,000 crores in Feb and March. So we are very hopeful we'll cross and beat this number as we go forward.
Right. Mr. Narang, also in the light of your recent order wins in Africa, how is the Transrail positioning itself to capture the long-term opportunities from Mission 300 Africa, the World Bank-led initiative that's aiming to connect 300 million people by 2030?
So Africa, we already are working in 15 to 16 countries. We are doing more than 20 odd projects. And we believe that we have a very good strength on the ground in various countries. We have the country heads, we have execution leaders there. So we are very well entwined with meeting and building our opportunities there. So teams are on the ground working closely with the utilities and with the project teams. So we believe that Africa, we will look at right opportunities. Of course, not all opportunities, but right opportunities where we believe margin profile and execution timelines are met.
All right, but with this, Mr. Narang, we let you go. So good having you on the channel today. Thank you so much for your time. All right, but with this, viewers, now let's put the spotlight on Aether Energy. Even that stock is on the roll because, yes, of course, the markets are doing pretty well on the back of the deal announcement. But for Aether, is the results that were definitely fantastic that the company posted this time around. And look at the move in the stock price. It's a more than 12% gain is what we are getting to see. What's the outlook going ahead from here on, and what will be the key drivers? Let's try to understand all of that. And for this, we are being joined by Mr. Tarun Mehta, co-founder and CEO of Aether Energy, joining us on the show. Hi, Tarun. Morning. This is Shrishti. And firstly, let's talk about the kind of growth that we have seen in your market share specifically, because it's been a journey one way upwards for you, is what we can see. Help us understand that what geographies are working the best for you right now, and going ahead, what will be the focus?
Thank you. So Q3 was a great quarter for us. Volumes grew roughly about 50%, revenue grew 53%, gross margin grew 300 bips, and EBITDA improved by almost about 1,400 bips over same time last year. So very strong improvements. We've seen a lot of volume build up over the last few quarters on the back of the new product Rista. Rista has particularly allowed us to expand into newer geographies. So we have seen a lot of expansion, particularly happening in Middle India, which are the states of Gujarat, Maharashtra, MP, Odisha, and Chhattisgarh. We've also seen pretty good gains in North India, in Rajasthan, Punjab, Jammu Kashmir, and even Uttar Pradesh recently. So all of this culminated to give us a very strong operating leverage. We've been razor focused on our engineering to drive costs down, and that's the 3% improvement that you see in our gross margin. And all of it came together for a very good landing with EBITDA in Q3.
Right. Hi, this is Ankita also joining in. Good morning to you. And also tell us, how with the new EL platform, when is it expected to be launched in FY27? And will this help open up the northern region further for you?
Absolutely. So EL is our more versatile scooter platform. It also has a better cost structure, which is more suitable for more mainstream audiences looking for a more traditional scooter. We are set for launch later this year, and we expect it'll do two things: improve margins across existing price points. But given its lower starting cost, it'll also help us introduce
We
lower
had,
priced products,
in fact, in the
expanding
last
our overall
call, I
accessible.
had mentioned that we would be from a 24, 25.
Yeah. So we definitely expect EL to improve market share, particularly in Western and particularly North India. We've already seen strong gains. Market shares in Gujarat are at 25%, in Maharashtra we're already at 18%. But if I look at Odisha, if I look at Madhya Pradesh, Uttar Pradesh, Rajasthan, I think there's further potential of 5, 6, 7% market share improvement. Easy, and that I think EL can certainly help us with.
Good to know about that. That's one of those exciting factors. But the other factor is the increase in the commodity prices. Tarun, what's the plan to manage that? Because that's one of the key questions we have been putting to all the auto OEMs. Because for Aether as well, we have already seen you taking a bit of a price hike recently. But with the rise in the commodity prices, will you be open to take some more?
So honestly, this is not your traditional commodity cycle. These are some crazy numbers at play right now, which is why we proactively took the 3,000 rupee price hike at the start of January to better manage any potential hits here. We are cautious for the rest of the year on commodities. Also, partly why we are really focusing a lot on improving margins across the board. For us, we have actually several levers in our business. So increasing ASP of the base vehicle is one. We also have non-vehicle revenues, which have been compounding very rapidly. Already 14% of our revenues come from non-vehicle sources. Particularly, the largest among them is a sale of software. Our software attach rates, despite a deep penetration in the country today, still stands at 90-91% across our fleet, giving us a very high revenue out of a very high gross margin product, and that's holding up our margins well. We also have charging infrastructure revenue starting to kick in, and accessories revenue particularly starting to ramp up. So we have all these levers stacked up. That coupled with a higher margin expectation from EL in the next 1 year, we think we are well prepared to absorb any potential hits coming from commodities in the coming quarters.
Right. Tarun, also talk to us about the non-vehicle contribution to the revenue, which is 14%. How do you see that growing, and what are going to be the levers for growth?
So non-vehicle revenues traditionally in our business, in the two-wheeler business, has been largely all about spares, which is service, and a little bit from small accessories. At Aether, our dynamics are a bit different. For us, about half of that, almost 50%, more than 50% comes from sale of software, which is obviously very high margin. A small component comes from service, and a small component comes from accessories. We are very bullish on all three. From a compounding perspective, obviously service we are the most optimistic about, because legacy businesses can command 7, 8, 9% of their revenue also from service. For us, that number is like a fraction of that today. So with every passing year, as the fleet size keeps increasing, we expect the spares contribution in our business to keep rising up quite secularly. And which is why I've been saying that I believe non-vehicle revenues can compound to something like 17, 18, 19% over the next few years. So there's a lot of potential in non-vehicle revenue sources.
Right, that's good to know. But Tarun, along with that, we also saw in your presentation that you have plans to add more of your experience centers. For now, it is close to 600. You want to scale it up to 700. Help us understand which geographies will you be focusing the most on?
So we're targeting about 700 stores by the end of this fiscal. So by basically the end of this quarter, we are quite optimistic about that guidance. The majority of our expansions now coming in the non-south markets. Aether has a strong presence in the southern markets. We actually still the least penetrated, the least distributed product in the southern markets, but relatively we have better presence in south. But there is a tremendous opportunity in the middle Indian markets and the North Indian markets, and particularly the North Indian markets over the rest of the year, I'm quite bullish on. as our product portfolio expands, Rista's entry in our portfolio allows us to go from 200 stores to 700-800 stores. The expansion of EL in this portfolio will allow us to add several hundred more stores in the next few years. I do believe we can get to distribution which matches that of legacy competitors over the next few years.
All right. Those are some great plans there. But lastly, Tarun, just a quick question on the lithium-ion battery cells. It's not with respect to your earnings, but in the latest budget, the custom duty rationalization was done over here as well. You being a player there, just wanted to understand that will this have an impact on the industry players like you as well?
No, I think it was a good continuity of policy. Lithium-ion cells, given that the domestic supply is still quite sparse and not really there, lithium-ion cells had a rebate on import duties, and that rebate seems to have been continued. I'll await for more details, but directionally that's what it seems like, which is a positive. That means a risk of a cost escalation has been pushed out for a few years now.
All right, on that note, thank you so much for joining us. We'll let you go on that note, Tarun. But with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we'll get you more managements on the other side. Stay tuned.
Welcome back. And yes, of course, we are in the thick of the earnings. And in this conversation, let me take it forward to Mr. Rajesh Sharma, who's the MD of Capri Global Capital Limited, joining us onto the show. The company did come out with the stellar earnings, but what's the way forward from here on? Let's understand more on that. Firstly, very good morning, Mr. Sharma, and thank you so much for your time. Let's talk about your growth numbers then, because growth from 30,000 crores to now 50,000 crores. How quickly can this be achieved in terms of your overall numbers? Why don't we start with that?
Yeah, thank you. So I think we reported the strongest quarter in terms of profitability and growth both. As regards reaching 50,000 crore AUM, which earlier we have said that by FY28 we will achieve the 50,000 crore mark. But given the strong momentum at the ground level, led by our branch expansion, which is now to 1,331 branches, and further branches expansion in pipeline, we think that this year we'll reach about 30 to 34,000 crore rupees AUM, and by next year we should be around 44,000 crore is the plan. So in the mid of FY28 we should reach that 50,000 crore AUM, and we intend to close FY28 in the shade of 50,000 to 55,000 crore. We revise the guidance also.
Right. Hi, good morning. This is Ankita also joining in. Sir, also, what will aid that kind of growth and the gold loans? Will this be a steady state business? You have given a guidance of a 45% mix?
Yes, so as far as gold is concerned, we are now in the current quarter, we'll achieve our nearly 1,000 branches put together, focused only on the gold, besides the MSME, micro lab, affordable housing branches put together will be close to about 1,400 branches. So gold will be in overall AUM will be in the range of about 45% in a 1 year, 1.5 year from now. Currently, it is in the range of about 41%. So it will reach to 45%, led by this expansion of branches, and the way the gold loan from unorganized sector to organized is moving. I think everybody is doing well, and also the price hike in gold is also supportive to this.
All right, but along with that, Mr. Sharma, off late, there has been a lot of volatility with respect to the gold prices specifically. If you can just help us with the latest number on the LTV and what are the risks here, any, if at all?
So it's very interesting and pertinent question in the recent hike and then sudden drop of the gold prices. We do the lending by the 30 days, last 30 days average gold price. Plus, when the gold was rising so quickly, we had taken the conservative LTV policy. So in the month of December onwards, our LTV were not doing 75%, but we are doing 70% to 65%. Currently, our entire portfolio at LTV level is less than 65%. So we at portfolio level, we have more than 35% of margin despite the gold prices have corrected due to our conservative approach in giving the LTV and also 30 days price mechanism criteria. So that way, we are quite safe. Individually also, when there is adequate safeguard margins, measures are there, where the trigger, whenever the LTV breaches, the message go to the customer, branch people do give a calling, and ask the customer to recoup the margin by giving a 14 days notice. For example, a 1 lakh rupees loan, if there is a 4% drop in the LTV, we are supposed to recover 4,000 rupees from the customer. And at individual level, that is a easy target to recover that amount to bring the LTV back. Failing which, if the customer do not deposit, we have right to again inform him and carry out the auction of the gold as per the let down process. So being portfolio very granular, the risk is minimized and widespread.
Right. Mr. Sharma, talk to us about the MSME segment. Were you cautious due to the asset quality issues seen in this segment?
And this MSME is a very wide term. So if we talk about secured collateralized MSME versus MSME unsecured, both the portfolio price points are different, and so is the risk and the risk framework. As far as the Capri is concerned, we are doing collateralized lending where either underlying office premises or shop or the residential house is mortgaged. So in our case, even the case happens NPA for any region, we have right to recover by going to SARFAESI or otherwise and recover the dues. So in our case, portfolio quality is quite stable and the credit cost is quite under control, contrary to unsecured MSME.
All right, and lastly, Mr. Sharma, if we talk about your cost to income, that is seen to be rising yet again. Where are you investing? Give us some sense. And is a 4% ROA sustainable?
Sure. So if you look at our last year, same quarter, our cost to income ratio was 58%, which has come to 51%. Of course, the previous quarter, it was 49%, primarily because we have done the provisioning for the incentive of the employees, which we are running some of the contest. Plus, we have opened about 70 plus branches and hired the new people for the upcoming branches in the next quarter. So that number of employee costs have been uploaded upfront. Because of that, the 2% quarter-on-quarter cost income ratio has gone up, but overall in yearly basis it has come down by 7 basis point. Overall, our target is to bring to cost income ratio from current 51 to 45% in next 1 year. With the growth in the scale, I think that is easily achievable.
All right, Mr. Sharma, on that note, thank you so much for joining us with the Q3 results and the growth roadmap ahead. We'll let you go on that note, and it's time for us to slip into a short break. Don't go anywhere. After the break, we'll get you more updates on the market, so stay tuned.
Welcome back, and yes, of course, the markets are reacting positively to the historic trade deal between India as well as the US. And on this note, we spoke with Sanjay Mukim, head of equities of India Equity Research at JP Morgan, to understand his take on the India-US deal. Let's go across and listen into that.
Solution on the trade deal is a good outcome for the overall economy. And more so, look, because our industry is now competitive with the 18% tariff. We are at or below peers in Asia or South Asia. And this should provide enough of fillip to our manufacturing industries, the ones that were tariffed for a while. And I think the market's reaction is very logical in response to the potential for Indian economy, for the Indian manufacturing sector to benefit from this deal.
And well, with the trade deal overhang gone, Vallabh Bhansali of Imam Group says buying activity will return to the sectors like defense, semiconductors and electronics. Let's go across and listen into what he had to say.
See, large bucket that already defines semiconductor. So the bulk will go into that. And there is critical amount of electronics, etc. That will also happen. So I think much more than any except the big items that you mentioned, we haven't opened our markets really. I would think fundamentally in terms of agri products, etc. I'm sure that we will have ways not to flood our country. So on the whole, I don't see any major disruptions except the energy part.
All right, but with this, viewers, we are completely timed out in this edition of Buy Now Sell Now. It's a goodbye from me and Ankita and the entire team who put the show together. Thank you so much for tuning in.